Trillions of dollars flow through the bond market every single day, more than the stock market. Yet most retail investors barely understand how bonds work. Bonds are loans. You lend money to a government or company. They promise to pay you back with interest. Simple concept. Complex mechanics. Today we go deep. When a company needs to raise money, it has two choices: issue stock, giving away ownership, or issue bonds, taking a loan. A bond has three core components: the face value, also called par, usually $1,000, the coupon rate, the annual interest percentage, and the maturity date, when you get your principal back. A 10-year treasury bond with a 3% coupon pays $30 per year, then returns $1,000 in year 10. Bond prices and interest rates move in opposite directions. This is the most important relationship in fixed income. Here is why. You own a bond paying 3%. Suddenly the market rate rises to 5%. Nobody wants your 3% bond anymore. They can get 5% elsewhere. So your bond's price drops until its effective yield matches the new market rate. Conversely, when rates fall, existing bonds paying higher coupons become more valuable. Duration measures how sensitive a bond is to interest rate changes. A bond with a duration of 7 means its price falls roughly 7% if rates rise by 1%. Long-term bonds have high duration, more sensitivity. Short-term bonds have low duration. The yield curve plots short to long-term rates. When short rates are higher than long rates, that is an inverted yield curve, and it has preceded every US recession in the past 50 years. Not all bonds are equal. Credit ratings measure default risk. AAA is the safest. US Treasuries, Germany's bonds. Investment grade ranges down to BBB. Below that is high yield, also called junk bonds. Rated BB and below. Higher risk means higher yield. A junk bond might pay 8% while a treasury pays 4.5%. The spread between them is the risk premium investors demand for taking on default risk. There are several types of bonds you should know. Government bonds, issued by national governments, lowest risk. Municipal bonds, issued by local governments, often tax exempt. Corporate bonds, issued by companies, higher yield. Inflation-linked bonds like TIPS adjust your principal with inflation. Zero coupon bonds pay no interest but are sold at a deep discount. And convertible bonds can be exchanged for company stock at a set price. Why hold bonds in a portfolio? 3 reasons. Income. Regular coupon payments provide predictable cash flow. Diversification. Bonds often rise when stocks fall, balancing your portfolio. Capital preservation, especially in retirement, when you cannot afford large drawdowns. The classic 60-40 portfolio, 60% stocks, 40% bonds, has produced solid risk-adjusted returns for decades. When the stock market crashed in 2008, US Treasuries returned over 25%. Bonds are not exciting, and that is exactly the point. In a world chasing 10-baggers and meme stocks, a steady 4 to 5% return from investment-grade bonds, compounded over decades, quietly builds serious wealth with minimal volatility. The bond market is the backbone of global finance. Every central bank policy decision, every inflation print, every recession fear, it moves through the bond market first. Understanding bonds means understanding money itself.